Hello, and welcome to this episode of The Financial Translator, where we discuss financial topics in layman's terms to move you from confusion to confidence on a given topic. I am your host, Kirk Kreckmeyer, the Principal Advisor at Pebble Valley Wealth Management. We are a fee-only financial advisory firm helping our clients make informed decisions on their road toward financial security. You can find more information at pvwealthmgt.com. On today's show, I'm going to provide a market update with returns through the end of February. I also provide this update and some graphs on my blog post you can check out as well. And as a quick comment here, given through the end of February comments I'm going to give you here, the Iran bombing happening after that, and so most of my comments will not include that. I may throw out a few comments here and there, but and also as a brief legal disclaimer, my discussions here should not be construed as financial or investment advice, and each person's situation is unique. All right, let's go. So we'll start with the usual table on my blog post. So on the screen, viewers can see the typical 1 year, year to date, and then 3 and 5 year returns. One quick comment, I guess, throughout this blog post, I'm going to be talking about things may look somewhat calm and looking at overall indice returns, maybe not much going on, but there's quite a bit going on underneath the surface. And so I'll mention that a few times throughout this blog post as we go. So as you see the table on the blog post there, let's first talk about I'm going to call it the 5 green boxes. One of them is pretty light, but I'm going to still call it green. So those are all the bigger returns. They turn green for the month here of February. They're all driven, in my opinion, by the similar thing or the same thing, which is falling interest rates. And so I'll get into the bond section of the blog post a bit later. But in general, the 10-year rates fell about 30 basis points, 29 to be exact, and the 2-year 18 basis points. And so when rates fall, it impacts some asset classes more directly than others. So the first one, the most directly that it's going to impact, you'll see the Treasury bonds. So the 7-year and the 10-year, the 7-year and the 20-plus year, 2.5% and 4.5% returns for the month alone. Those are pretty darn big moves for bonds. So again, as rates fall, the longer the maturity, the bigger the return you have if rates are falling. So that's why you have the first two there, green there because of the falling rates, because of bonds. Then if you look up in the top section there, you got U.S. real estate. So those are equity-like, definitely equity volatility if you look to the far right on the standard volatility. But REITs have higher dividends. They kind of like a bond-like return. So there again, falling interest rates are going to help that asset class. And so that's why a big driver of that 7.7% return for the month was also to falling interest rates. And then finally, the next section there, international equities. That's been a story since 2025, and it continues to chug along. International equities are up yet again, 4.6 for international developed and 5.5 for emerging. So just a quick comment on the year-to-date returns. What do we got? 10.1% developed and 14.8 in emerging. So again, these are just 2 months' work. So that's some pretty popping returns there. But there again, so it's like, well, what do interest rates have to do with that? Remember, relatively speaking, as the short-term rates fall relative to other countries, the U.S. dollar weakens a bit. Since your money is invested across seas, when you bring it back home to calculate your U.S.-based returns, you got the weaker dollar helps the returns in that regard. So part of that return you're getting is also, again, driven by the falling rates because of the weaker dollar. So that is the quick five greens on the screen, if you will. Then if we look at the rest, again, we'll come back to Bitcoin. That's the one big bad red on there. I'll talk about that in a second. But the rest of the asset classes mostly are a small positive, one exception being the U.S. large cap, small negative, but minus 0.8, let's call it. So there again, mostly nothing really jumps out other than the overall slightly up. Again, a lot of stuff going on underneath the market, which I'll talk about. And then the other thing too, I mentioned the interest rates fell a lot, and so the Treasury bonds were up 2.5 for the 10-year. Let's stick with that one because we're going to talk about corporate bonds now. So similar duration for corporate bonds, but if you look down to that section of the table, they were up, which is good, but only up about 1.3. So why not as much as Treasuries? That tells you that credit spreads have widened. So the relative risk in the market, we're starting to price some of that back in, and that's why the returns weren't as high. And then finally, saving the worst for last, I guess in this case, Bitcoin. So minus 21.7 for the month of February. Definitely been a rough start ever since last October. I think October 7th or 10th was the relative peak. Been coming down since then. Most of this damage, I was looking at the graphs in detail on this. Most of that damage was done the first few days of February. So since then, it's been somewhat, relatively speaking, for Bitcoin, relatively stable down there. So I do remain bullish on this market. There is the Clarity Act that's I think going to be passed very soon in Congress. When that happens, I think that's going to be the catalyst. But until then, it just can't seem to get out of its own way. So that's a quick summary there. So that's it for the table. And now on your screen, you're going to see our typical cumulative graph. And so we grab some major exchange traded funds to capture asset classes and what's going on. Normally it's a year-to-date graph, but given the short frame here of 2 months, we continue this month again to show you all of 2025 as well. So technically this is the 14-month total return graph. I'm going to stick with the more detailed ETFs that I have on the screen. So it's a bit busier graph, but it tells a better story, in my opinion. So looking at it, I guess the 2 or 3 things jump out at me. I'll just comment on it briefly. So one, the top 2 lines, yet again, remain the international equities. And this is a quick comment. I will mention what's happened since February 27th. So this graph ends on February 27th, and you can see international equities leading the pack up there. Definitely since then. So I'm recording this on Thursday, March the 5th. And since then, out of the gates, Monday morning, markets weren't that bad, but Tuesday was a pretty ugly day. And then again today, I'm recording this at 11:54 to be exact on Thursday. This morning so far, markets are down quite a bit. So I'm saying all that because if you look at this graph through last night's close and through noon today, those international equities have been getting hit the hardest, and so especially emerging markets. And so that magenta line quite a bit lower than you're seeing there at the 53.25 on the screen. What else to note? So the dark green line there, those are commodities, and so you can see that big drop. You may recall last month we talked about the day before the month end, the precious metals got clocked, and so they recovered some, not back to that relative peak of January 29th, but they had a pretty good month. I think they were up 1.1 for the month. So that's the commodities that stood out to me. And then what else? The REITs. And so I mentioned from the table up above, the REITs had a very solid month. And you're looking at it like, where are they? Where are they at the top of this graph? Well, they're down at the bottom. So I commented in my blog post that REITs have been struggling. They've been lagging quite a bit throughout 2025. So yes, making a strong showing, again, mostly driven by interest rates, in my opinion. But so they had a great month, but they're still only the second best now return over the last 14 months. And then bonds, bonds are doing what they're supposed to do, which is slow and steady and, up lower left to upper right on the graph. So nothing surprising there. However, take a look, 9.18% return for bonds over 14 months. And so those are some pretty damn good returns for bonds. So yes, they're doing their thing, but they're actually really kicking ass because, bonds, if you're getting, 5-6% for the year, doing pretty well. Again, these are 14 months, but bonds have had a very strong run, much lower risk. And so make sure you got a portion of those depending upon your risk tolerance, but bonds are not evil, and make sure you have some in your portfolio. One more thing on the equity markets, my focus graph of the month, if you will. So on the screen now, you're going to see it's the same 14-month length, and so it's a similar context as what you were just looking at up above. Now this is going to be, I included the S&P, and then I grabbed a few ETFs to give you an idea of what's going on underneath the market. And so if you look at the graph on the screen, that purple line, the 18.42, that's the same 18.42 that you saw up above with the major asset classes. And then I've got a few other graphs, some up, some down. So let's talk about what's going on underneath the S&P 500. The first thing to note I'm going to mention is the sector dispersion. So focus on the blue line, I guess the light blue line, in case there's another dark one there. The light blue line and the lime, let's call it, light green line. So again, pretty much in the month of January and February here, late January, early February, utilities. So the dispersion, again, sectors within the S&P. Utilities had a big pop there. They were up, I think, about 10% for the month. And then if you look at the most negative or the most least performing sector was the consumer discretion. So the big drivers there, Amazon and Tesla are in there. But so anyway, that the big dispersion of that, growth versus value, if you will. But I just grabbed the two most extreme sectors. So that's one thing going on. There's a lot of sector dispersion or sector rotation, I should say, going on in the market. The next thing I grabbed, the orange line. So if you have any factor investors out there, you got value factor, quality, dividend payer, low vol. And so this particular one is the dividend factor. I just happened to grab the Schwab's dividend payer. It's I think it's the 100 largest large cap stocks with dividend payers. You can see that relatively lagging. If you look at throughout 2025, kind of flat. It was definitely trailing the overall S&P, but starting actually late last year, started to catch a wind, and then January was solid, and again in February here. So it's doing well. So second thing going on in the market, look at the factors, and right now, dividend payers, low vol div, a couple of factors are doing quite well. The next section I grab, I guess two more, stay with me here. The next one, the magenta line. And so you see that chugging along, and all of a sudden, early in mid-January started falling, and then pretty hard in late January. That is the software ETF sector. So I think it's IGV is the ticker for those following along at home. That one, the software sector got hit pretty hard on the back of, I think it was Claude. One of the AI companies announced Anthropic. I'm sorry. So it was Anthropic's Claude has the ability to possibly write help efficiently write code for some of these software services. And so this software as a service company, Microsoft, Salesforce, a lot of the CRM companies got hit really hard. So that was a big pullback there. So great story from the years past and part of some of the Mag 7s, but they definitely got hit pretty hard on the back of that news. Not the market's not saying that those companies aren't going to be around. They definitely will be. They have a great service, but it's more of the pricing power. So software as a service, you pay a monthly fee. Maybe you're not going to be willing to pay as much of a fee if you have some alternatives, especially for smaller companies. And so that's where the market priced that in very quickly. And then finally, I'll just mention it briefly here, and then later I'm going to be talking about, as my special topics is private credit. So I show two more lines here, a couple of private credit publicly traded companies. And so specifically KKR is that light brown line, and Blue Owl, which is made my newsletter last month, but that's the dark green line there. So those are private credit companies, publicly traded. These are the stock prices of them. So again, you can see it's not a surprise. Coincidence, I'll talk about the connection. As the software stocks were selling off, these publicly traded credit card companies sold off. So I'll talk about it in my special topic later, but just want to point that out. Down 50% again over the last 14 months on Blue Owl, and down 40% on KKR. So definitely some things going on underneath the market. So now I'm done talking about the equity market. So that is what's going on. And again, overall surface looking good, but definitely some stuff going on underneath. And so it's good to look at your portfolio, know what you have underneath it. So now let's jump to the next graph on the screen. Here is going to be my bond yield chart. So on the blog post, I have both the last 1 year and the last 30 years. I'm just going to show you the last 1 year on the podcast here today. Same usual yields we have. So I guess a couple of quick comments that what stood out to me this month. One is, pretty big rate move. And so again, I'm glad I started showing just the 1 year. So you can finally see, if you look at the light blue line there, ending at 3.97 for the 10-year rate at the end of February. It fell, I mentioned earlier, 29 basis points for the 0.29%, 29 basis points for the month of February. That's a pretty big move for bond land. And then you can see the others went along with it. So the orange line is a 2-year. That's down at 3.38 at month end here. And then the 30-year, the light green line, that's down to 4.64. So rates fell is one noticeable thing on there. The 2-year fell, but not as much. And so that's called the curve flattened. And so at the bottom of that graph, I show the 10-year minus the 2-year rate. So I think it was 71 basis points last month. It's now 59. So, 10 11 or 12 basis point flattening there. And then, with these lower rates, I mean, again, getting a 10-year below 4%. I think it was last month or 2 months ago, my special topic was mortgage rates. So definitely mortgage rates are starting to, or I saw it in the news prior to this week, even a couple of sub 6% mortgages available. So again, pay attention to that market. Unfortunately, with the Iran bombing, I thought there might have been more of a flight to quality on the treasuries, but the problem is with potential inflation, with the oil scare, the interest rates have been going up. And so again, most of my comments are ending here at February, but just a quick comment to what's been going on since then. Interest rates are going back up, and so the 10-year, I guess at 4.14 this morning. So again, that big fall that we had in February, a lot of it being taken out the first few days of the month here with the Iran bombing. Back to my graph and comments through the end of February. So the other thing to note, the magenta line there, 4.91 on the triple B credit curve. Again, hard to see, but I did the calculations. The credit spreads are widening out, and so triple B, like investment grade, but the low end of the investment grade was up 18 basis points. That's a triple B spread, and then the single B high yield spread was up 36. And so again, movements going on, so just be aware of it. Again, going up in quality is a good thing to do these days, in my opinion. That's probably enough on the interest rates. And so let's move on. So now the Federal Reserve, it's always a 2-day meeting. So the next one concludes on March 18th. The pricing in the market is not expecting any rate cuts. And so don't expect any movement there. The fireworks this time will be, or the interesting thing to watch will be it's a summary of economic projections. So 4 times a year, they put out, the Fed puts out 19 views, 19 opinions are shared. Unemployment rate, GDP growth, inflation, and then where they think the interest rates will be at the end of each of the successive years. And so when you do look at it, just as a quick reminder, the dot plots, those are end of year 26, 27, 28. So it's not what they're thinking about over the next meeting. It's by the end of the year. So that's what's going to be happening. Again, a lot of stuff going on in the world between now and then. So we'll have to see how that changes. But as of now, anyway, market is not expecting any rate cuts. And the summary of economic projections will be the main thing to watch. There was a bit hotter inflation reading. The PPI came out. I forget when it was. Let's just say it was last week. It's been kind of a busy time. So anyway, inflation has been coming down, but it remains sticky. And the Fed's preferred PCE gauge is even stickier, kind of staying elevated. So that's the other dynamic. People will be watching their inflation views of the Fed. So that is a quick summary of the Fed and the upcoming Fed meeting ending March 18th. Now for my special topic this month, I thought I would focus on private markets, but private credit in particular. Earlier I showed you a couple of the publicly traded private credit companies, Blue Owl and KKR. So in general, stepping back, what is private credit? How big is it? Should you worry? What's going on? So one, definitely I'd say pay attention to it. I'll show you a graph in a second, but right now I was at the Morningstar conference last summer, and it was all about private markets and being aware of the growing size of the market, but also being skeptical about it. It's being pushed in different areas, and so being aware of what's going on. And then last fall, there was this company called Blue Owl was in the news trying to restructure one of their private deals. I don't know all the details, but let's just say it was one of their private deals, private credit market deals. And the market pushed back on that. Like, no, you can't do that. That's for the new players in there, you're not going to let you do that. And then along came, earlier I mentioned the big sell-off in the software stocks. And then related to that, again, remember that graph I was showing you, software stocks, I guess from your perspective, fell quite a bit. And then right behind it were these Blue Owl and KKR and other private credit stocks of those companies. So let's talk about that. So private credit market. So on the screen right now, I'm showing you, and these graphs are from the JP Morgan Guide to Alternatives as of January 31st of 2026. So on the screen you have just how big is this market and has it been growing? So you can see. Let's focus on the gray bars and let's go to say the last 10 years. And so you can see quite a bit of growth going on. in the last 10 years on this direct lending. So that's that's what I'm going to talk about, is these direct lending private credit markets that's getting my attention and the market's attention. So the growth has been there. The other thing too is 2016, 17 is when it really has been growing quite strongly since then. But we haven't had a deep credit cycle, meaning we haven't had a default cycle come through since then. So this market hasn't been through a credit cycle yet. So another thing to note, it's been going on great. People are loving it. They like the high yields, but it hasn't been tested yet. And then I'm not going to show the graph on my screen, but on my blog post I have of that direct lending there. Why was there such a reaction after the software stocks sold off? The reason is because a big portion of the loans that they're making, these private credit loans are making, are concentrated in the software sector. So again, another graph from JP Morgan shows there's about 40% of the deals over the last 5 years on a global basis were centered in the software sector. So it's not everything. If it's got to be 20% to 30%, maybe for some of these companies, pretty high percentage. And so anyway, that's what's going on. You've got a very fast growing market. The size of this, the private credit market, again, sourcing JP Morgan's report there, it's similar in size to the leveraged loan market, about a 1.3, 1.4 trillion dollars. So it's big. It's been growing a lot. And they have a lot of loans to the, some of these private software companies. And so if there is a pullback in those markets, if the market's beginning to question, hey, a lot of money being spent on these data centers, software companies, if there's potential, will they be able to deliver the profits from those companies? And if there's a question about that, some of these private credit deals, private credit loans could come into question about, will there be more defaults than the market is expecting? So that's the main thing to point out. Again, I'm not an expert in it, but it definitely bears watching. And you might also hear, say, oh, not to worry, the default rates are quite low. And it's true, they are. Another graph that was in the JP Morgan Guide to Alternatives showed default rates. And yes, they're ticking up for private credit. But the other thing is these payment in kind loans. And so if they're not able to make the actual loan coupon payments, they just say, well, let's just add it to the principal. I'll pay you back later. Or, well, let's just issue some equity to you. I'll pay you back later. So they call it extend and pretend, or payment in kind. But again, some of these default rates in the past may be lower because of that. So again, not saying it's going to be systemic by any stretch, but definitely there's some issues going on there. It bears watching and seeing what's going on there. So let's, I guess, the old Hill Street Blues line, let's be careful out there. So that is a wrap on this month's market. Again, looks pretty calm and steady on the surface, but a lot of stuff going on underneath. So make sure you know what you got in your portfolio, what's moving, depending upon your view, position accordingly, and check out the blog post for the additional graphs that we have there. And then also too, it's again March 5th. So on Saturday, don't forget, it's one of my more favorite days of the year. We spring forward on the clocks, and so bring on the evening sunshine, I say. So those early morning exercisers, as I look over to my colleague Bree here, maybe not as happy, but for the evening folks wanting to exercise late, bring it on. And then also March Madness. And so March 5th, I'm not even sure when the announcement week is coming, but March Madness is coming, and I'm a Nebraska alum. And so I guess Nebraska has a very powerful basketball team this year. Who would have thought, it was Indiana football winning the championship and Nebraska basketball. So I reference a link to my blog post. Jason Gay had a comment about that. So check it out, kind of a clever line. So anyway, that's a wrap on today's topic. Thanks a lot. Thank you for listening to this episode of The Financial Translator. I hope this discussion helped clear up any confusion and will lead to more confident financial decisions. Thanks for your time, and be sure to check out all of our resources at pvwealthmgt.com. Until next time, go confidently.